I remember back when I started investing 5 years ago, I dove headfirst into buying and selling shares of individual companies. An approach that was complex, time-consuming, and ultimately cost me a load of money at the beginning. In reality, I should have started by investing in funds, which are baskets of stocks that might have 30 or 3,000 companies in them, because having these diversified investments in my portfolio would have reduced my risk when I first started, whilst I built up my knowledge and confidence. But even when it comes to funds, there are so many to choose from. So today, I'll be looking at the 5 most popular exchange-traded funds, or ETFs, on Trading 212 and giving my thoughts on them. But first, what are ETFs? An ETF, or exchange traded fund, is just a basket of investments, such as stocks, bonds, or commodities, that you can buy and sell on the stock market just as easily as you can buy or sell shares of companies. They tend to be less expensive than managed funds, because ETFs are usually passively managed, meaning they will simply track and try to match the performance of a certain area of the stock market rather than employing a bunch of analysts and experts and fund managers to try and outperform the market. So let's dive into the 5 most popular ETFs on Trading 212 right now. We'll start with the most popular ETF, which is the Vanguard S&P 500 DIST, ticker symbol VUSA. And saying that makes me realize that actually now is a good time to break down how to read a fund name. Vanguard is the ETF provider, S&P 500 is the name of the index that the ETF is tracking, DIST stands for distributing, meaning any dividends received from the fund will be paid to you as cash. And the opposite of this is AC, or accumulating, which are ETFs that will automatically reinvest any dividends received from companies back into the fund. Finally, the ticker symbol VUSA is simply a unique code to identify this particular ETF. Okay, so that's the fund name broken down, but what does this fund do? Well, it's a great option for those looking to invest in the US stock market. This ETF tracks the S&P 500 index, a collection of 500 medium and large companies in the United States. Think big names like Apple, Microsoft, Nvidia, Amazon, Meta. They're all included, and they actually make up a big chunk of the ETF. By tracking the S&P 500, this ETF aims to mirror the performance of the stocks of those top 500 companies. It's worth mentioning that this index is market capitalization weighted, which simply means that bigger companies have a bigger impact on the performance. For example, Apple, Nvidia, Microsoft, Amazon, Meta, which is Facebook, and Alphabet, which is Google, make up almost 1/3 of this ETF. In terms of costs, this is one of the cheapest ETFs out there, with an expense ratio of just 0.07%. This means for every £10,000 you invest, you'll only pay £7 in fees to the fund manager each year. There could always be some other fees with your investment provider, which is actually one of the reasons why we've used Trading 212 for the past 5 years, because they have extremely low fees. And by the way, if you do want to open an account with Trading 212, you can actually use promo code SNSBonus to get free fractional shares up to £100 when you join. This is an affiliate link, which means we do get a small payment if you use our code. Finally, let's go on to the performance of this fund. It has returned 18% per year over the past 5 years, driven by the incredible performance of the US stock market, and in particular, the big tech companies such as Microsoft and Nvidia, who I feel like I keep mentioning. I will talk about the 5-year returns of all these ETFs today, so it is worth reiterating here that past performance doesn't guarantee future results. Just because an ETF has performed well in the past doesn't mean it will perform well in the future, just as an ETF that has performed poorly in the past won't necessarily perform poorly in the future. Now, the S&P 500 index funds like this ETF have been the go-to investment for so many DIY investors like us. That's because it follows the world's strongest economy, the world's best companies, the expense ratios are really low, and the performance has been stellar for pretty much the past century. It's even the recommendation of investing legends like Warren Buffett, and I'm certainly not going to argue with him. I think a lot of people are worried about how big a percentage of the S&P 500 these big tech companies make up, because it kind of takes away from the idea of spreading your risk when you're so concentrated on just a few companies. And I completely get that. But on the other hand, these companies are really strong businesses. So personally, I would be comfortable with that. However, saying that, I don't actually invest in an S&P 500 ETF, as I'll explain a little bit later. Now, you might get a sense of deja vu for the second most popular ETF on Trading 212, because it is the Vanguard S&P 500 AC ETF. Ticker symbol VUAG. So the only difference between this ETF and the one we've just looked at is the fact that this ETF is accumulating, hence having AC in the name rather than distributing, which is why the previous ETF had DIST in the name. This means that any dividends received by companies within this fund are automatically reinvested. Unlike the previous ETF, they won't be paid out to you as cash because they are reinvested back into the fund itself. This means you'll see a higher absolute return with this ETF because dividends aren't taken into account when you look at the performance of the ETF's share price. That's why this ETF has returned an average of 19.5% per year over the past 5 years, which is higher than the 18% average annual return of the previous ETF, despite them both investing in basically exactly the same companies. The only difference is that the first ETF will pay you out dividends as cash, meaning you get your extra returns that way. Personally, if I had to pick between these two ETFs, I would go for this accumulating version. I don't need any dividends, and any I did receive, I would reinvest immediately anyway, because reinvesting dividends is one way to boost your investment returns. However, if I was interested in generating income from my investments, then maybe I would opt for the first ETF that paid out dividends. But right now, I'm just interested in growing my pot of investments as much as possible, so I would opt for this accumulating S&P 500 index fund. Oh, one final point. You might have noticed that both these funds are in British pounds. A lot of questions have been asked over the years about how much of a difference this makes when investing in ETFs like these, if you should invest in the pound-based one or the dollar-based ETF, and there's some euro ones, so which one to go for? And the answer is, it makes no difference to your investment return. The only difference is that by investing in a fund denominated in British pounds, you can avoid any potential foreign exchange fees charged by investment providers. When you do invest in foreign companies, like those based in the US, then currency fluctuations are always going to impact your returns, regardless of whether you choose the US dollar denominated fund or the British pound denominated fund. Should I have been saying pound sterling? It's fine. Now, the third most popular fund on Trading 212 is the one that I would most consider investing in. That is the Vanguard FTSE All World AC ETF, ticker symbol VWRP. If you want global exposure beyond just the United States, this ETF is a great option. It tracks over 4,000 companies from 45 developed and emerging markets, allowing you to spread your investments across different countries and sectors. It's still weighted heavily towards the United States because a lot of these index funds will be more impacted by the larger companies, and US businesses are still the biggest in the world. Those 7 big tech names that we mentioned earlier still make up a big portion of this ETF, but it's only 20%, compared to making up 33% of those S&P 500 index funds. Truth is, this is why my personal preference is to invest in a global index fund. I don't mind the fact that over 60% of the ETF's performance is driven by US stocks, because it is probably the strongest stock market and economy in the world, but it is nice to know that I'm not solely relying on the United States. This fund has also delivered strong returns for investors, with an average annual return of 15.7% over the past 5 years, albeit that does still trail the S&P 500's 19.5% with dividends reinvested. Now, I don't actually invest in this specific ETF because it has an expense ratio of 0.22%, which, to be honest, isn't that bad. There's just an ETF by Invesco, who are a reputable provider that also tracks the FTSE All World Index, but only charges a 0.15% expense ratio. But overall, this is the ETF that gets the biggest thumbs up from me. Now, the fourth most popular ETF is something a bit different. The iShares Physical Gold ETC, ticker symbol SGLN, which tracks the price of gold. Technically, it's not an ETF, which stands for Exchange Traded Fund, but it is an ETC, which stands for Exchange Traded Commodity. An ETC is just like an ETF, except it tracks the price of a commodity, in this case gold. This specific ETC is physically backed, meaning the fund provider holds actual gold bars in secure vaults. Gold is often considered a safe haven asset, meaning it tends to hold its value when the economy gets shaky, which is why experts often recommend to include it in a diversified portfolio, albeit only as a small amount. We currently don't have any gold in our portfolios, but we do have this. Ta-da! I'm trying to remember how these beauty YouTubers do it. Something like this, right? So this is actually a tiny gold coin which is worth £250, and it's an alternative way to invest in gold. But investing in this ETF is probably easier. Now, it's fair to say that the world has been a bit shaky over these past 5 years, which is probably an understatement. We had a pandemic, we've had wars, we've had inflation, all things that should send investors heading to a safe haven like gold. While stocks have soared in this time, gold has also done alright, with this fund returning an average of 13.6% per year over the past 5 years. For me though, there's a big difference between this fund and the others we've looked at in terms of how you would construct an investment portfolio. I would happily make a global index fund, like the Vanguard FTSE All World ETF, the largest core holding of my portfolio, like up to 80% of my total portfolio, because it gives me instant diversification by investing in thousands of companies across the globe. I'd even be happy to make the S&P 500 a core holding because of the strength of the US economy. But I probably wouldn't make this ETF, the gold one, more than 10% of my portfolio, because it's there just to help you balance your risk a bit and potentially counteract any downturn in stocks. It's not really there to build a portfolio around, but that might just be me. The final ETF in the top 5 is the iShares Core S&P 500 AC ETF, ticker symbol SXR8, which if you hadn't guessed, is once again an accumulating ETF tracking the S&P 500. The fact that S&P 500 index funds have appeared 3 times in the top 5 makes me wonder if I'm doing something slightly wrong by not investing in any. But anyway, the only real difference between this fund and the accumulating ETF that we saw earlier is the provider. This one is run by iShares, which is the ETF arm of Blackrock rather than Vanguard. So these ETFs might be popular on Trading 212, but are they actually worth investing in? Honestly, I think so. As I said, if I were to start from scratch, I would make global index funds the majority of my investment portfolio. So I might look at the Vanguard FTSE All World ETF, although I would actually pick the Invesco FTSE All World ETF because it has slightly lower fees, but it's also newer with less of a track record and it holds slightly fewer stocks, so you could make a case for investing in either. Since over 60% of this global fund is made up of US companies, then it's clear I feel confident about the US economy and its stock market too. So I would happily invest in an S&P 500 index fund if I didn't already have so many US companies through both my global index fund and my individual stock holdings. And if I had to go for one on this list, it would be the Vanguard S&P 500 AC ETF, ticker symbol VUAG, because I would happily let the dividends be automatically reinvested, as this will help to boost my returns in the long run. Finally, the iShares Physical Gold ETF. I'm not against having it in my portfolio, but I feel like I have quite an aggressive investing approach with a lot of time on my side, so I'm personally happy to have a portfolio full of stocks. I say my gold coin is enough diversification for me. So that's a wrap on the 5 most popular ETFs on Trading 212. I hope you found it interesting, and feel free to pop any questions you have down in the comments below. And if you'd like to follow along with our investing journey, don't forget to subscribe to this channel. Thanks a lot for watching, and I'll see you next time.